Thanks for joining me on the Wealth Nation podcast. I'm Yolanda, I'm a wealth advisor, and it is my goal on this platform to give you easy, actionable tips, content, and strategies that you can use to manage money well, to live abundantly, and build generational wealth. So, the South African Reserve Bank has lowered interest rates, and that's what we're talking about today, the pros and cons of lowering of interest rates by the South African Reserve Bank. We're going to try to understand how it makes sense and how we can make it work for us as the average South African. First, we got to understand what the interest rate means. In South Africa, we have two very important rates that we need to pay attention to as South Africans and as investors. Firstly, it's the repo rate. So, the repo rate is short for the repurchase rate. This refers to the rate at which the South African Reserve Bank lends money to private banks, right, where we do our regular banking. The repo rate, once that's set, then we have the prime rate. That's the rate at which banks lend to us. The repo rate directly impacts the prime lending rate, and banks add additional interest to the repo rate so they can earn a margin on the loans while taking the buyer's risk profile into account. So that's the interest rate in South Africa that we need to be paying attention to. Different types of products have different sort of interest rates. For example, home loans, credit cards, personal loans, vehicle finance, all different levels, right? But what does the lower interest rate mean? We can't look at interest rates just in isolation. We got to look at it with that lens of inflation. Inflation is the general rise of price in goods and services in an economy over time. And central banks all over the world, not just the Reserve Bank, they aim to keep inflation in a controlled range to prevent economic instability. Right. So, in the case of high inflation, South Africa has been struggling with this since the pandemic. If inflation is too high, it erodes the purchasing power of our money. You know this. You have bonds, you've got car finance, credit cards. You know how little your money can buy you when the inflation rate is high. So, the SARB may increase interest rates to cool down excessive spending and borrowing. You know this as well because sometimes the interest rates become too much and then we shy away from using credit cards. We shy away from borrowing, right? It's the SARB's intention to do that because it's the velocity of money. We did a whole podcast about this a while back, a couple of years back, and I will put a link in the description of where you're watching this or listening to this and listen to that podcast on the velocity of money, and hopefully it would make sense to you. So the higher interest rates make borrowing money more expensive for businesses, for consumers. For example, higher bond rates or car loan payments mean that people have less disposable income to spend. Right? As a result, the demand for goods and services fall, slowing down inflation. Right? And obviously, when that demand falls, it affects jobs. As a small business owner, when people are not buying, I don't need so many staff now. Right? So there's a knock-on effect of all of this. In periods of low inflation or even deflation, and we saw that in the early months of the pandemic, if inflation is too low, there's a fall in prices, deflation, and this can signal a weak economy and lack of consumer spending. And at that time, the South African Reserve Bank reduced interest rates to stimulate the economy. Remember, South Africa is still very much a cash economy, a lot of informal shopping, informal workers, laborers, domestics, so they need cash. And when that lockdown happened, cash was slow because many people were not working, and that slowed down the entire economy. So the SARB had to stimulate spending by lowering interest rates. A lot of people went into loans, bought houses and things, not because they could afford it, because the criteria of the banks changed because of that lower interest rate. So lower rates makes loans cheaper. It encourages business to invest and consumers to spend, which increases the demand for goods and services. So more goods are produced. More people are hired to produce the goods. More people are hired to distribute the goods. Same with services. More people are hired to perform those services. And again, it goes in the cycle of higher inflation over time. So inflation is actually a cycle. And again, linked to inflation, interest rates is a cycle. When the economy is slowing or in a recession, the central bank would lower interest rates. This would make borrowing less expensive, encouraging businesses to expand, invest in new projects. Consumers are more likely to take out loans for big purchases, homes, cars, since the cost of borrowing is reduced. Increased spending stimulates the economy, leading to job creation and higher economic activity. The slowing of growth happens with higher interest rates. If the economy is growing too quickly, causing inflation to rise too rapidly, SARB may raise the rates, like we've seen, to cool things down. This discourages borrowing and investment, as higher interest costs make it less attractive to take on debt. Consumers cut back on spending and businesses delay expansion, which can help moderate economic growth and prevent inflation from spiraling out of control. The SARB's goal is to strike a balance between controlling inflation and promoting steady economic growth. So they typically have an inflation rate target of 3 to 6% in South Africa, and by adjusting interest rates, they aim to keep inflation within this range while encouraging sustainable economic growth. And we know that inflation this month is sitting at around 4.4%. And if inflation does drop further, we can expect further interest rate cuts from the Reserve Bank. Changes in these rates take time to filter through the economy, often 6 months to a year. So the Reserve Bank has to act based on predictions of future economic conditions. So one of the pros of these lower interest rates is cheaper borrowing costs, easier access to loans for businesses and consumers. I know the South African banks are still a bit wary. The criteria to borrow is very, very tight. It's a boost on consumer spending. Unfortunately, not the wise people listening to this podcast, but people will be spending more, taking out more loans, tapping those credit cards. Consumer spending usually tends to boom when interest rates become lower. Businesses are also more likely to invest in growth projects with lower financing costs. By lowering the interest rates, it does give the economy a little bit of a boost because, like I said, people are spending more goods need to be produced, more people are needed to produce the goods, deliver the goods, and produce the services that people are looking for, so jobs come up. And hopefully we can see those positive job numbers in 6 months' time. The downside of low interest rates is people that are saving in interest-bearing products, right? This will have a negative impact on savers, as lower interest rates mean lower returns on savings account and fixed deposit. There's also a risk of overborrowing, and we find sometimes banks especially, they tend to overlend, and the banking statistics have shown there's a lot of distressed borrowers, a lot of defaults on personal loans and credit cards. So the bank's got to be wary not to loosen their criteria when it comes to borrowing, because they don't want bad debt on their books as well. All right. There's also that potential for inflation because it's a cycle. It'll swing from one end to the next. All of this spending could increase inflation rising if the economy overheats due to increased consumer spending. But lowering interest rates are good, especially for small business owners, because more spending really impacts their bottom line. For homeowners, it's great because more of your payments towards your bond is going to the capital portion and less on interest. To be a savvy, especially on your primary residence, and try and stick to those higher payments, try to pay down that bond earlier. Investment property is a different story. It's also impactful on investment returns. Traditionally, how the asset classes works, when the cash market starts drying up, people are more inclined to invest in equity. So possible boom to the equities, especially U.S. equities. U.S. dropped their interest rate by 0.5% the day before the SARB did. The key takeaway here, I believe that it's good for the economy, more spending. You need to be the wise somebody, not overspend. Use this opportunity to start paying down debt, and hopefully we can see a couple of more rate cuts coming into 2025. And you got to be wise, you got to be savvy. Don't get sucked into consumer spending. Put more away towards investments, towards retirement, and really make the lower rates work for you. Thanks for joining me today. Catch me next time on the Wealth Nation podcast. If you want to speak more about getting your hands into some nice interest-bearing investments, even equity investments, feel free to reach out. It's www.solomonwealth.co.za, or you can go to our financial education website, financiallyfabulousfemales.com.